another news story that is making the rounds as far as the United States and the US economy is concerned. It's important to highlight the fact that the ratings agency Fitch has put the United States credit on watch for a possible downgrade on Wednesday. This, of course, has raised the stakes as talks over the country's debt ceiling have gone down to the wire and has only added jitters in global markets. Important to highlight that right now this is just a warning, and the United States still has a chance to, in fact, end that stalemate. In fact, the US Congress still has a chance to end that stalemate. The credit ratings agency has placed the top-ranked US credit on rating watch as negative. And that, of course, means that it's reflecting the uncertainty surrounding the current debt ceiling debate and the possibility of a first-ever default. The move comes as Republicans and Democrat politicians are negotiating to raise the US debt limit. Remember, the limit ends on the 1st of June. No deal has yet been reached, with the Treasury Secretary Janet Yellen already saying that the US may be unable to pay its bills as soon as 1st of June. The country faces the possibility of an unprecedented default, which could, of course, have disastrous effects both in the United States and all over the world. Fitch, as we all know, is one of the top 3 credit rating agencies, placed the US as AAA on rating watch negative, signaling that it could downgrade US debt if lawmakers do not agree on a bill that raises US Treasury's debt limit. Meanwhile, important to also highlight, the euro fell on Thursday as Europe's largest economy, Germany, was confirmed to be in a recession, while the dollar hit a 2-month peak, benefiting from safe haven demand as worries are mounting about a US default. Also, let's have a quick look at some of the key facts on why this warning by Fitch matters. The credit ratings signal the health of a nation's economy and tell investors how risky investing there may be, effectively assessing how likely it is that a country will pay back its debt. The second point to keep in mind is that ratings can determine the type of credit extended to governments and on what terms, in theory, a lower ranking means higher borrowing costs, affecting its ability to raise more money. Thirdly, the ratings of 3 credit agencies, Moody's, S&P, even Fitch, play a particularly large role in how investors view a country. A downgrade would potentially likely mean higher borrowing costs for the US government, but it could also ignite broader financial turmoil across the board. And with that, let's try and understand why this warning by Fitch matters. Let's try and get in a sense of perspective. I'm joined in by Mr. John Quelch, who's the former Dean of Miami Herbert Business School of the University of Miami. Many thanks to you, Mr. Quelch. It's a pleasure to have you on my show. But before we weigh in on that scenario, let's also focus on the potential ramifications. What could a negative rating mean for the US economy, and why does it matter? Because remember, the common man still wants to know its impact on their lives.
Yes, the negative rating is not good news. It's important, though, to realize that the rating watch negative is not a downgrade. It's just a warning.
Right.
And of course, on June the 1st, the United States will not go into total default. Whatever happens, it may miss some payments, but it will not be a total default. Nevertheless, this is not good news. In 2011, S&P, Standard & Poor's, stripped the US of its AAA rating,
right,
when we had a similar situation to this one. And by the way, Standard & Poor's has never reinstated the AAA rating on the US dollar. Fitch in 2011 and 2013 also issued rating watch negatives, but it never actually downgraded the dollar on either occasion. So this is not good news. It's just another example of warning signals that suggest a very, very serious outcome for the US and the world if the default does actually get triggered as a result of the debt limit not being raised on or by June the 1st. So it's just another warning signal that everyone should realize underscores how serious the situation is.
And the warning signal that could very well turn into a reality by 1st of June. Having said that, even if politicians manage to strike a deal and avoid defaulting, Fitch has warned that frequent political standoffs over debt ceiling have already begun to damage the US in the eyes of investors. Should US Congress finally be more cautious than ever?
Well, of course, the U.S. Congress should step up to its responsibilities to fund expenses that have already been approved by the Congress itself. So we're talking here about blocking a raise in the debt limit, which would simply facilitate the government, the Treasury, paying obligations that the U.S. Congress has already committed to. So it's a little bit disingenuous of the Congress to be blocking this raising of the debt limit. You know, I'm hopeful that cooler heads will prevail and that there'll be a ratcheting down of the emotion around this issue and a realization of the tremendous functional consequences that will occur to U.S. unemployment, to U.S. interest rates, to potential for increased recessionary outcome in the U.S., all of which will, of course, not be good for the world economy. In 2011, when the last scenario like this played out, and there was a protracted delay in raising the debt ceiling, the U.S. stock market went down 20% in the time that it took to get the job done. So we're looking at significant consequences if this situation is not resolved.
All right, Mr. Fitch, before I quickly wrap up, what are the broad factors that could individually or collectively lead to that negative rating? Not to forget factors that could also lead to a positive rating or an upgrade. If you could just broadly explain that to me.
Well, I don't think that there's much prospect of an upgrade because obviously the US dollar is already triple rated by Moody's, for example, and by Fitch, slightly lower by Standard and Poor's. And, you know, to be frank about it, there aren't alternatives that are really significant to the dollar as an international trading and settlement currency. Yes, most central banks do diversify their reserve holdings beyond US dollars to other currencies, but relatively speaking, the US dollar is still the standard for international settlements. So if there is a problem here, it will definitely diminish the reputation of the dollar. It'll be another knock in the dollar. That will, over time, perhaps facilitate the emergence to greater prominence of other currencies as alternative international currencies.
All right.
But I've got my fingers crossed at the moment in the hope that the US and, frankly, the global economy will be able to escape this one.
Absolutely. And in a very pivotal year as far as US politics is concerned, I'm sure Joe Biden or Kevin McCarthy, both of them cannot afford to not reach an agreement before 1st of June. Many thanks to you, John Welch, for joining in.